Hi guys, don't forget to click on the subscribe button.
I don't know I have any special thoughts beyond the news on the coronavirus. The very first day I bought stocks was March 12th, 1941, 42. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening, my dad told me the execution price, it was down 2%. If you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably, if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like, and you can buy it even cheaper, then it's your good luck, basically.
Although there are a lot of people who look at the market and they say, look, I want to buy, but I don't want to buy when the market's sitting at new highs, when it's been hitting new records every day. Maybe it's off 800 points this morning, but maybe there's more of a decline to come because the effect of the coronavirus is going to be an impact on the global economy. IMF said that over the weekend. You are going to see weakness as not only China, but other countries try and address this. You're right, it may not change things over the 5 or 10-year span of things, but if I think that I can buy something for potentially 10% cheaper, maybe more than that if I wait a week or a month, maybe that's what I'm sitting around.
Well, if you think that, then you're going to get fabulously rich if you're right. All you have to do is just keep buying at 10-day intervals and keep taking your 10-day prediction. If I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page say, let's say it's selling for 30. It isn't selling that low, but that'd be 42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower in it. But you don't have that.
But if I worry that the economy is going to slow down, not just for the quarter, but for the year, that would impact how many cars I think they might be able to sell or even produce.
I'll guarantee you cars are going to slow down someday. In 1932, General Motors had 19,000 dealers. That's more than all the auto dealers in the United States today. There are only 125 million people then, but they had 19,000 dealers. They produced or sold, and there was one month, I think, when they sold less than 1/10 of a car, right at 1/10 of a car per dealer. That was a terrific time to buy General Motors. Forget about the market. If you can predict the market, you don't need to read balance sheets. You don't need to read anything. You certainly can't predict the market by reading the daily newspaper. That is for sure. And you certainly can't predict the market by listening to me. But you're buying businesses. And if you had planned to buy a local service station yesterday and it was closing day, I don't think you'd tear your hair out or anything like that. You'd have already looked at where it was located and the contract that it had with the suppliers and made a decision on competition. People, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment. And you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it.
You made a point of that in the letter this year where you highlighted a book that was written by Edgar Lawrence Smith back in 1924. And you said until he came along, nobody really realized the compound interest effect of buying stocks, not just buying businesses, but buying stocks themselves.
Edgar Lawrence Smith changed the world with that book, and the people have forgotten all about it now. Although in the 1920s, it became more and more gospel as the boom went on. But Edgar Lawrence Smith set out to write a book on bonds versus stocks. And he said if he went in with the idea that bonds would be a better investment in times of deflation and stocks would be a better investment in times of inflation. And the first line of his book was to say that he'd been wrong. But he had enough sense to look at his evidence. I think Darwin said if you found evidence that was contrary to what you already believed, write it down in 30 minutes or your mind will just block it out. I mean, people have a great resistance to new evidence. And he said, if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that had been true for a long, long time, but nobody paid any attention to it.
That led Keynes to actually say that this was an important book. People paid attention to it, but you're right, it added to the frenzy that built up to 1929.
Well, that is true because you can get, my old boss Ben Graham told me very early on, you get more trouble with a good idea than a bad idea because the good idea works. I mean, it's a good idea to buy a home, for example, and then people go crazy. The good idea works, and it works, and it works. Stocks work out better than bonds most of the time. And after a while, people forget that there were some other limiting conditions. With Edgar Lawrence Smith's book, it was that when bonds yield the same as stocks, which was the case then, that stocks are going to outperform because they have this retained earnings. So stocks started going up in the 20s, and all of a sudden they were selling at 5 or 6 times the prices as when he bought the book. And the original correct perception on his part had experienced changing conditions, but people just looked, they got their confirmation through stock prices. And people, that's what happens in bull markets. People start out thinking stocks are cheap, and then they start thinking stocks have gone up. and a stock can be a good buy or a bad buy. A bond can be a good buy or a bad buy. It depends on price.
But that leads us to today. I mean, if his premise was that stocks are always going to be a better investment than bonds, that's kind of what you hear today, which we've been hearing for a while, is Tina, there is no alternative, right? You have to buy stocks because bond yields are so low, because interest rates are so low.
Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case. I mean, but it's usually been the case in America, very usually been the case. And if you buy a 30-year bond today with a yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, that's clear. And that's one of the alternatives people have. People really have 3 basic alternatives: short-term cash, which is an option of doing something later on; long-term bonds or long-term stocks. And stocks are cheaper than bonds.
Charlie said recently, Charlie Munger, the vice chairman at Berkshire Hathaway, had his daily journal meeting just a couple of weeks ago. And at that meeting, he said that there's a lot of wretched excess out there and that there's a lot of trouble coming as a result. Do you agree with that?
There's always trouble coming. Yeah, there was trouble coming in 1942 when I bought that first stock, all kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks.
Would you repeat that this time? If trouble's coming, would you still say buy stocks right now?
I would say buy stocks if you get enough for your money.
Right now, Berkshire Hathaway is a net buyer of stocks. You are in a net buying position?
We've been a net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. And there's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
But you wrapped up your partnership at one point,
I wrapped up my partnership once.
Because you thought it was too expensive?
Yeah.
Okay. But this is not a time like that?
We own $240 billion worth of stocks. Now, we look at that as $240 billion worth of businesses that we own parts of. But I love owning those businesses.
You've also got more than $125 billion in cash sitting around.
Yeah, well, we'd like to buy more businesses.
We are here, Warren, with you at Berkshire Hathaway's headquarters building. This is upstairs in the room that's called the Cloud Room. And this is a room where you often take students to kind of talk to them about questions they have when they come to visit you. You also do some other things up here, too, other presentations.
Yeah, I had students here for dozens of years. And for many years, 40 schools would come in. They'd come in groups of 8. At 5 days, I'd spend a year, and they come from all over the world. We had them from Peru, we had them from China, we had them from Israel, and we had a good time always. I've given it up now, but I started teaching when I was 21, and when I got to about 88, I thought, I'll take a rest.
Well, there are a lot of questions that are coming in from viewers that have been hitting here today. You have a lot of economic data at your fingertips because not only are the many businesses that Berkshire owns, but the businesses you own pieces in. What are you seeing right now around the globe?
Well, it affects various businesses. I would say that I received commentary. I get some commentary monthly from almost all of the companies, and a good many of them had some comment about how it was affecting them, and however it was affecting them at that time, I'm sure it's accentuated. But they were affected by tariffs, they're affected by taxes, they're affected by, I don't have the faintest idea what our businesses will be doing 6 months from now or 12 months from now. I do think that not only our businesses, but American business generally will be doing fabulously better 30 years from now or 20 years from now. And the long term is in my view, is very easy to predict in a general way, but an important way. I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now. So I work on what I think I'm able to do, and as desirable as it might be to know what was going to happen 10 minutes from now, that's just not something I'll ever be able to master. So fortunately, I can come to a pretty firm conclusion that 20 or 30 years from now, American business, and probably over the world, will be far better than it is now.
What are the momentary implications that you've seen from coronavirus? What's an example of a business?
Well, an example, for example, we have maybe 1,000 Dairy Queen franchises in China here, and they're just treat only, so they're the older type now with food. But a great number of them were closed, but the ones that were open weren't doing any business to speak of. And Apple is, I mean, our much bigger holding is Apple. We own 5.6% of Apple, and the company came out and said that it's affecting not only its stores, but all kinds of things, supply chain. And I find that certain of our companies have got supply chain arrangements that are being affected by this that I didn't even know had those.
Like what?
Well, I got one from Johns Manville the other day, for example. You wouldn't normally think of them as having a big supply chain, but Shaw Carpets, or you name it. I'll guarantee you that a very significant percentage of our business is one way are affected by it, but they're being affected by a lot of other things too. And the real question is where are those businesses going to be in 5 or 10 years? They'll have ups and downs. Our candy business is a wonderful business, but it loses money 7 months out of the year. But the nice thing is Christmas comes every year.
When you look at the economy and how things were kind of chugging along, let's say beginning of this year,
yeah,
when things first picked up, how would you gauge the U.S. economy at that
point?
Well,
it's strong, but a little softer than it was 6 months ago. But that's over a broad range of business. You look at car loadings, rail car loadings, that's moving goods around.
Why do you think business was down, let's say, the last 6 months? Is that a decline in confidence, or is it coming off of levels where there was unusual activity ahead of that?
Well, it isn't really down. It's just it leveled off and a little softer maybe now. But, well, tariffs, the tariff situation was a big question mark for all kinds of companies, and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now?
Hi guys, don't forget to click on the subscribe button.